Hey, it's Kurt. Hey, let's talk a little bit about keeping receipts. One of the most common questions that we get is how long do I need to keep receipts? What expenses can I write off? And how do I keep track of all of it? So let's go through that together. I'm going to take you directly to the IRS website so we can see exactly what they expect of you. So if we are sitting here as we are today in 2026, as I'm recording this video, I would be archiving anything that is in 2019 and prior. Now, if you're keeping a digital record of these items anyway, you can archive them for longer. It's probably not, taking up substantial amounts of space using Google Drive or SharePoint or OneDrive, any of those types of document management solutions that are out there. But I do think that you should be having strong active records for the previous 7 years, or you should be looking at that seventh year is the one that you're going to be into your archive pile, your delete pile. If you keep physical records of those copies, then 2019 are the copies that you would start to shred at this point. Now, you're going to notice that when you have a business or you have a piece of property or any type of asset, your keeping of records becomes really critical in order for you to substantiate your deductions. Some records are part of your permanent file or part of the file that are important to keep for longer periods of time. So for instance, if I buy a house in 2026 and my family and I move into that house and we have all sorts of expenses related to maybe redoing the basement and redoing the floors right when we move in, I would want to keep those in my house files. And that wouldn't necessarily be part of my 2026 records because I can't do anything with that house right now if it's for personal use. But it may come into play down the road when I sell that house, where I need to know, did I actually have a gain or not? We live today in an environment where you can sell a house and have a $500,000 capital gain exclusion. But what if that changes in the future? What if that goes away entirely? You're going to want to have every record that you have associated with certain things. So your stocks, your investments, your home, those are things that really belong in more of a permanent location, a permanent folder. But your business records and those things that are part of the income and expenses of your business or your real estate, those are things that you should be keeping track of for 7 years at a time. And so the records that the IRS wants you to keep, this is their website documenting the types of things that they think are important. It doesn't require you any specific or special kinds of records. I will tell you that receipts are really, really helpful. They're more valid than credit card statements. But to the degree that those expenses are less than $75, there is some wiggle room there. Just be aware it's better if you have every receipt, and especially in some of those higher risk categories like travel, meals, vehicle deductions, supplies. Those things are some of the more at risk for a spot check audit. And so I think it is important to have more detailed records on each of those items. This how long you should keep them, as long as you need to be able to keep and prove income in deductions on your tax return. With the statute of limitations and some of the ways that the IRS approaches this, 7 years is sufficient. The recording of your business transactions requires different things. So if you have payroll and you're paying people, or you are sending out payments to 1099 contractors, that documentary proof needs to be in other formats beyond just the expense on your bank statement. So in other words, you should keep your payroll documents, the 941s, the W-2s, 940s, all those items should be kept as well because they're critical to the records. The burden of proof is on you to be able to substantiate these. So that means that you need to be able to have the records that back up your deductions. There's certain things that become easier over the course of time if you've got systems in place. And so I think having a document management system, getting in the habit of digitizing some of your records, saving your bank statements and credit card statements, taking pictures of your receipts or using a receipt management system can be really helpful. These are all ways that you can substantiate and keep track of your expenses over a long period of time. Now, a follow-up question to this that I think is really critical is, well, what exactly can I write off? And the answer to that is it really depends on the context of your industry. So you get to write off what is reasonable and necessary. And you need to be able to document and substantiate. So these things are linked together in concept. But if you look at the 1040 Schedule C as an example to this, you can see certain categories of items that are critical. They want to know your gross receipts or sales, like how much came to you in the form of income that you earned in the business. So if you are doing a lot of things on deposit, or you are having people pay you amounts that are not necessarily fulfilled, like if they prepay, then we probably need to have a discussion around what we're going to put in gross receipts and how you're going to keep track of that from year to year. The other thing is if you had to do a return or an allowance to someone, if you have any costs associated with providing this particular service or product to someone else, so it would be your cost of goods or cost of services. And then your other income. So think like if you have bank rewards or travel credits, if you get cashback rewards on a business credit card, things like that, those would go into these categories. What you can deduct are things like advertising costs, marketing, promotional items. You get to write off some of these vehicle expenses, and check out another video that we've recorded on that. That'll give you some more specifics there. Things that may be commissions or fees to others, if you have to pay a commission or a fee to someone to substantiate it. You'll notice, if we'll bring this up in another video, but you'll notice that even if you're writing off things and expenses in the context of like a rental property, it's very similar in mindset here. You'll see things like commissions and fees that you're paying to perhaps a property manager, for instance, or somebody who's like a broker or finder for you, a finder fee. If you had to pay contract laborers, depreciation on the vehicle if you're doing a combination and you're taking actual expenses, things like that. And you'll notice all these expenses have some names associated with them that you would typically use for your write-offs. And it gives you some context for what you can and can't write off. Now, the tripping hazards here are these. Number one, your taxes is not your federal and state taxes paid. That goes into a different place for your state taxes. State taxes are a deduction to you, potentially, if you're itemizing. But your state taxes, or taxes in this context, there's some reasons why you can write off your taxes paid to the state. There's other reasons why you cannot. So you need to understand that, and we can educate you on that. The other things that you can write off are some things for your use of a home office. There's also this other category for things that may not fit neatly and tidily into some of these categories. But all that to say, I want to show you one of my favorite tools that's out there for keeping track of it. Now, we do have a lot of clients that use QuickBooks, but years ago, we made the switch for our own purposes and with a lot of our accounting clients to a company called Xero, and that is Xero. This is their demo company file. So I'm not sharing any proprietary information here with one of our clients, but I am sharing with you some of the things that would be available to you that you would see on the homepage if you were one of our companies in this system. And this is something that you could manage yourself. It gives you the ability to keep track of and post items by connecting into your bank account and credit card accounts so that you can post some of these transactions and discuss with us, or to match these to invoices, and have these enter your books without doing a lot of typing. Now, you'll notice that once a vendor gets into your system, it becomes a little bit easier to find different ways of approaching this. Like, you may find that this is the invoice that this is associated with. In this case, there is no invoice that is associated with this particular transaction. So in this case, I would just go through and say, well, maybe I'd need to go and invoice this transaction, or I would just create it and post it to my sales category. But it gives you, you'll notice a lot of the categories that you saw in the Schedule C are listed here. So things like office expenses, repairs and maintenance, wages and salaries that you're paying to others, dues and subscriptions. We can help you to get this set up so that you can enter the transactions quickly and be able to post them in a way that makes your records clear. Because what you want to be able to do at the end of the day is get to a statement of income for yourself where you can clearly see how much money did I make, how much money did I spend, and it's already categorized appropriately. Makes it a lot easier to go through the tax season process. And then everything is ready to go to file your taxes. And the good thing is that from this, we can show you how to read certain things. You can now see what your net income is. We can give you a multiplier that says take 10% or 20% or 30% of that number, and that's how much you have to have saved for taxes at the end of the year. So it makes it easier for you to get from point A to point B, and we can watch over the books for you if you're doing it yourself. We can also do it for you. But this is a real simple way of you keeping track of the records in a way that's really helpful and relevant. You can see your balance sheets. You can see who owes you. You can see, who you owe in your accounts payable, things like that. So it's a nice, simple way that you can run the simplest of books or the most complex. We have clients that have multiple $1 million of business, multiple service lines that they're keeping track of all the individual details of this on a service line basis. So it's a very powerful tool, but it can also be a really strong way of keeping track of your income and expenses in a real clear and tangible way. What that means for us is if your financials are kept appropriately rendered throughout the year, then it puts us in a position to be able to help you to determine if you've saved enough, if you've got a tax bill looming. If you don't have good records, it's hard for us to ever be able to predict that. So this, I think, is a really important way of organizing your financials. And you'll notice on the record keeping function, the IRS has some idea that you are keeping a record in your books. If all you have right now is your bank statements and credit card statements, you don't really have a set of books. If you have an Excel spreadsheet, you're closer. If you have this, you are there 100%. So I think it's a healthy way of making some transitions and putting some maturity to the financial systems for your business, and would love to dive into this deeper with you if you would like. Thanks.